What's the Fed funds rate? It's the interest rate that quietly controls your entire financial life. From mortgages to market crashes, it all starts here. This rate sets the tone for every other rate in the economy. And when it moves, so does everything else. It's how the Fed whispers or screams at Wall Street. Watch the full video, because if you don't understand the Fed funds rate, you're flying blind in this economy.
Wrapping up this week's version of the Five Things, our educational topic. Today we're talking about the federal funds rate, Fed funds rate as we generally refer to it. We've talked about it a ton ad nauseum over the course of this show, but today we're going to talk about how to understand the Fed funds rate. Gary, why don't you give us a high-level overview real quick, and then I've got a couple of follow-up questions for you.
All right, so the federal funds market represents a portion of the Fed's reserves, and what that is where banks lend to the Fed or to other banks, typically overnight. The Fed can also loan funds to banks overnight, and banks rely on the system to meet liquidity requirements in a short amount of time. So remember that because we have a system where the banks can actually, it's called a fractional reserve system, and the banks can lend out more money than they have. They can have it be on like 10-to-1 leverage. They have to keep a certain amount of reserves. And so if they write, a certain number of loans and they may not have enough reserves, or they may have too much in reserves, they can go into this market overnight and borrow on a short-term basis. And so the interest rate for these overnight loans is called the federal funds rate, and it's typically, understandably, viewed as an essential benchmark for all other interest rates in the economy.
Gary, in terms of the Fed funds rate, because I think you see it often correlated, right, with mortgage rates and everything like that. Does the Federal Reserve set all of the interest rates, or how do we have to think about that?
The Fed only sets the overnight rate. It's called the Fed funds rate. The bond market, which is, you'd refer to that as a free market, sets the interest rates for everything else, whether it's 1 week, 5 years, 10 years, 20 years, 30 years, whatever it is. But typically, in a normal situation, those rates get set based off the Fed funds overnight rate.
Gotcha. Gary, we talk about yield curves a lot as well. So I know there's a couple different types of yield curves. The first I want to start with is tell us what a normal yield curve is.
Okay. So with a normal yield curve, interest rates rise as duration does. And that sounds complicated. It's actually really simple. Just think for a minute about somebody lending money for 1 year and how much, they'd say, okay, well, we have an interest rate on that. But now imagine that you're an institution taking the additional risk of lending for 30 years. You're trying to project out 30 years. Will this business or this person still be in existence? Will what will happen to inflation over that time? What will happen to the value of the money that you receive? What will happen to our economy? What will happen to the dollar? Literally, you don't know for 30 years, almost a third of a century, if the people you're lending to will be in business or not. So if you're lending for longer, you would typically, under normal circumstances, ask for a higher interest rate. So right now, the middle of the range on the Fed funds rate is set at, right around 4.3%. And so with a normal yield curve, what you would see is the 1 year being a tiny bit higher than that. Maybe I'm making this up. This isn't where we are right now, but you might see like 4.4, 4.5%. And if you go out to 5 years, you might see another 10 or 50 basis points there. And if we went out to the 10-year, you would get a higher interest rate for that, and so on. So as lenders lend for a longer period of time, they ask for a higher interest rate to compensate them for the additional risk, and that would be called a normal yield curve, where the interest rate rises as the length of the loan, called duration, does.
And Gary, what about a steep yield curve? So I know that's something that's a little bit of a variance off of a normal yield curve.
Yeah, so Rob, when the yield curve is said to be steep, is when the interest rates rise a lot as duration increases. So, we were just talking about, where as you go through the different points in the yield curve, the market might ask for maybe another 10 basis points or a tenth of a percentage point of interest. That would be a normal or shallow yield curve. In a steep yield curve, those increases might be 50 basis points or 100 basis points, where people are really uncertain about the future. And they're saying, yeah, I'm okay lending to you for a year, but if you want longer than that, we're going to charge you more. You want 10 years, we're going to charge you a lot more, So that is a sign that people are, seeing some additional risk there. And when interest rates rise disproportionately higher as duration increases, we would call that a steep yield curve.
Gary, and then finally, in terms of just types of yield curves, tell us what an inverted yield curve is.
So the inverted one is really interesting. When the yield curve is inverted, you have the opposite of what we just described. You would have a situation where as you go to the longer durations, the market asks for a lower interest rate. And so, somebody might say, well, wait, why would you do that? Why would you offer somebody a lower interest rate for a 10 or 20-year loan than you would for, say, a 2-year loan? And the reason that happens is because when the yield curve is inverted, and typically people will look at like the 2 to 10-year pairing, if the 2-year yield minus the 10-year yield is negative, they'll say, hey, we've got an inverted yield curve. And that will often signal a recession. So the reason for that is because people are projecting a weaker future economy, and they're saying, wait a minute, we're going to hit a recession. When that happens, the Fed is going to lower the Fed funds rate and bring down the whole yield curve. It doesn't always work that way, but that's typically how it works. And so, they're saying, wait a minute, if the Fed is going to lower, in the next 6 months or something like that, then, we don't need to ask for as high an interest rate in the future. But the key thing on that is it's typically a danger sign, because often when the yield curve uninverts, we end up in a recession. Now, that's something that just happened recently. So, we'll see if we end up with a recession right now. It's worth noting that first quarter GDP was negative, but that was on an anomaly. I don't think, it was necessarily the economy there, although that was an issue. But the first quarter negative GDP growth was actually related to inventory stocking ahead of tariffs going into place.
Very interesting. Thanks for breaking down all those types of curves, Gary. Let's talk now about low interest rates, high interest rates. I want to start on the low side because I think people enjoy talking about low interest rates more. But what are the advantages or disadvantages, Gary, of lower interest rates?
So when interest rates are lower, it encourages building and investing. So think about it, Ralph. Let's say you and I wanted to build a plant to produce something, and we could get a loan for, let's use a ridiculously low number, say 1 or 2%. Now, that's obviously an insanely low number. And we say, oh my goodness, like the market is willing to give us money for free or almost for free. And it won't cost us a lot to borrow money and try to build a new plant. And so with an entire economy thinking like that, it will encourage building and investing. The downside of it is it leads to an increase in asset prices, it leads to inflation, and it also leads to uneconomic, wasteful expansion, right? If everybody in the economy says, hey, money's free, we don't have to worry about a good return, let's just build stuff. If it works, we make money. If it doesn't work, we lose somebody else's money. You can end up with a lot of uneconomic and wasteful spending and growth. And by the way, that's the problem that China has had in their property market, right? They made it so that, the funding was effectively, zero or negative, and companies like Evergrande went out and they built more than there was demand for, and people who paid for apartments didn't actually get them. That kind of wasteful expansion leads to giant problems. In fact, the best examples for this are in China, where they have entire ghost cities. They built entire cities and nobody's living there. These places are just rotting.
Yeah. I know we talked about that. I think it was summer of last year, about these ghost cities, right? Just the Chinese real estate market. On the flip side, Gary, so let's now talk about high interest rates. Advantages, disadvantages of high interest rates. Curious on the advantages.
Yeah. So the disadvantage of higher rates is they tend to slow the economy. Just like we're saying lower rates encourage people to spend and invest, higher rates, they make it harder. And if you're going to build something new, you think, wait a minute, this is going to be expensive. How much capital do we want to put at risk here? How big, how much financing can we take on? It becomes more expensive and harder to do. But the advantage is higher rates tend to, when they slow the economy, they bring inflation under control. And stable prices are crucial to economic growth. Where you have a lot of inflation, you tend not to have a lot of economic growth. The uncertainty prevents people from investing for the future. When people feel like their currency is stable and inflation is under control and they have a good view on what's going to happen in the subsequent years, they say, hey, if I know what's going to happen, if we have a stable currency, that encourages people to invest. Higher rates also encourage a greater deal of caution and certainty when building new capacity. And so it doesn't eliminate it, but it reduces the probability of these, negative return, wasteful projects getting built. You clean out the kind of the garbage.
Yeah.
And there's an expression in the economy right now, they're talking about zombie companies. These are companies that under normal interest rates would just go out of business, but because they have financing at insanely low rates, in some cases around 0%, they don't run out of money quickly enough, and they have no value. They should be shut down. The assets should be sold off. The effort and resources going to keeping these businesses going and keeping them alive would be better spent on other kinds of things. But because these businesses don't die and you don't have what's called the creative destruction of capitalism, these worthless businesses keep absorbing people's time and energy and resources. Higher interest rates put a stop to that, and they make that kind of waste much less likely.
Gary, finally, to wrap this up, this is great. We've been covering a ton of different stuff here on the Fed funds rate. And I think as much as we talk about it, good for everybody. Finally, last question I had. You talk about, okay, these interest rates. In your opinion, I mean, how should these interest rates get set, right? I know you are and the Fed. I won't ruin the punchline, but yeah, how should these interest rates get set, Gary?
Well, Rob, that is the punchline. So I want everybody, people will often say, well, we need the Federal Reserve. Why? Well, they set interest rates, they provide financing. Okay. No, they make it possible for Congress to overspend. They make it possible for us to monetize our wasteful, enormous, multi-trillion-dollar deficits by, just writing paper for this. It's a disaster, but I want everybody to go through a thought experiment with me. Right now, if we have, 1 week debt, right? 1 week paper, the market sets the rate for that. If it's 1 year, market sets it. 2 years, 5 years, 10, 20, 30 years. Everything from 1 week to 30 years is set by the market. Why would it be so awful to have the market set the overnight rate? That's all it is. People talk about the Fed funds rate like it's this magical thing that can only be set by the Fed. This is 100% not true. It is simply the overnight rate for lending. It can and should be set by the market. And personally, I would much rather see the collective wisdom of the crowd, the collective wisdom of everybody participating in the market, replacing the decisions of a few unelected bureaucrats, most of whom have never run a business. So here's your tagline, Rob. Everybody all together now, end the Fed.
Great stuff, Gary. Great stuff. And that's going to conclude this week's version of the 5 things, the temporary tariff truce issue. Just need to take breaths in between each of those T's. Even the is in there. Wow, Gary.
Yeah,
but
anyways, I made it hard.
Yeah, great episode. We'll be back same time, same place next week, keeping you in touch with everything that you need to know in investing for the week. Again, head to our website, deepknowledgeinvesting.com. Use the Ask Gary features. Send us an email via ir@deepknowledgeinvesting.com. Check out our content. Again, some of that will be gated for our premium subscribers. We'd love if you consider transitioning from a free to a paid premium subscriber. And if not, no worries. I know Gary will tell you that as well. Thank you for watching. We'd love if you could like, subscribe, or dislike, and let us know why. That's super helpful too.